Good afternoon, everyone, and thank you for joining us this afternoon for this very interesting series that we have launched in the IPO, that is, Initial Public Offering. In this specific series, today is our part one, our episode one, in which we are going to dig deeper into IPO readiness and due diligence. For today's webinar, we have our two speakers. Uh, we have Miss Amita Desai, who is the head of corporate secretarial practice at Ascentium India, InCorp Advisory. She is also the co-founder of InCorp Advisory. She comes with 30 plus years of experience advising on corporate governance, compliance, and secretarial practice across Companies Act, FEMA, securities law, and M&A. Known for translating complex regulatory requirements into actionable strategies across IPOs, restructuring, foreign investment, and ESG compliances. She is also a veteran fellow member of ICSI and a registered insolvency professional. Welcome, Amita. Thank you for joining us today. And joining her will also be Abhinav Maker. He is a partner at one of the most known law firm of India, Trilegal. Uh, Abhinav he comes with 15 plus years of experience advising on IPOs, QIPs, buybacks, and pre-IPO placements. Abhinav has advised on landmark transactions including Delivery, SBI Cards, Mankind Pharma, and Dam Capital. Previously, partner at Shardula Merchant Mangaldas and Company with education from New York University and National University of Singapore. Thank you, Abhinav, for joining us today for this insightful webinar. I am going to, it's all over to you, Amita, to start the session. Thank you.
Yeah, thank you. Thank you, Dolly, for a brief introduction. And thanks, Abhinav, for joining today. Thank you. Good evening, everyone. Today, we are just starting the first part of the series of IPO. We will continue in the month of May and one more webinar and in June. So keep tuning in and we'll share what are the topics. So today, we are just starting what would be the ideal due diligence process kick in and how it should start with the due diligence, and maybe very interesting for any entrepreneur who is getting ready for the IPO, and also always the company secretaries how they can help the company in for the readiness into IPO. Give me 2 minutes so that I can share the presentation. Is it visible? Abhinav, is it visible?
Yes, it's visible, Amita.
Thank you. Thank you, Dolly. Yeah, so IPO is one of the major and significant corporate action for any companies in their life cycle. It's a complete transformation of the organization with its people, process, practice, the internal control system, and the total cultural change of transparency and accountability. So that's main important. If we see in the outlook of 2026, till last year, we are seeing that India was always considered as a value-led market for global multinational company for getting into the FPIs. A lot of FPIs and foreigners have invested in India, but in recent initial first quarter, we have seen that company or India has lost its TINA factor, which is there is no alternative kind of a situation till yesterday, till 2025. Now the South Korea and Taiwan are also one of the competitive emerging market, or where there's a lot of AI and silicon chip companies are there. So we have seen in first quarter a lot of foreign companies or foreigners and FPIs have pulled out more than 53 billion US dollar from Indian market. And then we have seen multiple bad news like the US tariff related matter, geopolitical tension with Iran, US war, and further devaluation of the Indian rupee, and a lot of uncertainty in the market. This is very critical role where during this capital market turbulence, due to domestic investor in coming in through the directly or through the mutual fund market is still steady, and support of this SIP FI inflows are making it little stabilized. But I think this is a good time for any company who are having a good business and growth and potential to keep the company ready for the preparedness and potential IPO, which they can come whenever the market outlook will improve. If we see that statistics of last one quarter up to the April 2026, on the main board IPO, there are 24 companies which has raised more than approximately 30,608 crore rupees. Majorly, these IPOs are offer for sale, like kind of a exit to the promoter or the early investors. And if you see on the SME platform, there are 51 companies. They have also raised 2,389 crores fund from the retail investor and from market. In the pipeline, we are seeing that major IPOs like Reliance Jio, PhonePe, Flipkart, SBI Mutual Fund, NSC, they are all coming, which are very good in IPOs, which are coming in the year in the pipeline. This quarter, these are just the name of the company who has come and capital has been raised. Now, in 2026, there are more than 222 companies which are IPO ready. If we see Zepto, Hero, InCorp, NSC, and Shadowfax Technology and Geo Platform, which will be the biggest size, I think, and we will see how the market will react to that. And once the market will improve, they will come with the IPO. So basically, why there is a need for any public offering, or why the funds are required for any company in their journey, they may require further fund after the debt and after the early stage seed or venture capital or the private equity investor. For various reasons, the funds are required, maybe for product development, for growth in the marketing, going global, infrastructure setting up, working capital requirement, or certain time repay the debt also. So if we see the use and proceeds of the fund in any IPO, these are the major where they are investing or they are using the proceeds of the public funds. Fundraising options, if any company or entrepreneurs, they see there are debt fundraising, equity, hybrid, and then there is an exit plan given to the early stage investor. In India, we say debt are basically initial stage. Banks and financial institutions are giving loan to the company in the initial stage. And then there are public issues of bonds and debentures, also non-convertible debentures we have seen in the market. Equity, we see IPOs can come with the SME board also and a main board also. SME size is a little smaller size. We are not going into the technical detail of that, but there are SME, BSC and NSC, both NSC emerge and SME IPO on the BSC also, that platform, and the main board IPO. Then the company can have a follow-on and the right issue, and the private equity is another way. Instead of going to the public, always the private equity is the initial stage where limited, and now the family offices are also there. They are investing in those companies, which will be faster also. And there are a hybrid kind of a instrument where there is a different form of equity and convertible debentures or convertible preference shares also. And there is an exit strategy through the merger acquisition or offer for sale to the early investor is possible. If we see outside India, if you want to raise the fund, it could be either external commercial borrowing, which is a debt with approval of the Reserve Bank of India, ADR, GDR, you can list overseas. FCCB, FCEB are also one kind of a bond where you can invest. You can raise the fund, and there are strategic mergers and acquisition overseas also. What are the benefits of getting listed in India for any entrepreneur? Before he start his journey, he should know why he wants to get the listed. First, he will get the valuation of the, if there is a scalability in the business, definitely will get the more valuation, transparency also. Diversification of ownership, it will be widely diversified ownership, but control still remain in the promoter's end, because if it's coming into the public issue. Liquidity for the any shareholders to exit will be easily available for the listed company. It increases the visibility of the company, the credibility and the prestige of the company if it is a listed and a good governed company, of course. Capital for growth also in the next round, also raising the fund would be faster if the company is doing very good and transparent, governance are good, then the follow-on money would be always available in the pipeline. Exit options are also available. Now, apart from the company, the benefit to the promoter also, he can unlock the value, whatever with the hard money or hard sweat he has used and grown the company. Now he can unlock his potential and get the value for his shares. He can retain the management control, and there will be a leveraging for his own share. He can listed share also can be refinanced. He can pledge the shares and he can get the investment, and he can sell and exit also. So in recent year, I think now the frenzy or the boom has gone about the IPO. The mindset of the investor are also very conservative. Now they are shifting completely a hype of funding into the or investing into the IPO because of the immediate value addition or immediate after the listing, they can see the value has gone little down. So now instead of hype, they review the fundamentals of the company, whether the company has potential, who are the promoters. So everything has been researched, and then the investors are now pumping in money in the equity, so that we are seeing that not 30 40 times the oversubscription is happening. Now we are reasonably seeing 2 to 5 times in a current bed market. It's happening. Quantity over the quality, though quantity is not required. Now the quality IPOs are coming. Discipline and patience is a new game for an investor. He has to have a disciplined mindset, and he should have a patience to have the value in the market. For any company to go for the IPO, what should be their strategy? They have to just monitor first the market. Of course, they have to monitor their business and scalability, but monitor the market and see the what kind of market mindset or what kind of market approach and how the market is going. And the test the IPO size also. Sometimes they are overestimating, and size should be aligned to the actual requirement and use of proceeds. So they have to revisit the use of proceeds, narratives to be set why they want and how exactly they are going to spend this money. Maintaining investors' communication is a very much important, and it's a key for any success. And plan for the post listing compliance also very much in advance, because once you are listed and your proceed or the journey starts, it would be very difficult if you think that later on I'll hire somebody has to be roped in well in advance, so that once you are listed you are ready with the team and who can handle the compliances. For any entrepreneur, the important is they should see the whether there is a scale and growth in the business, how he is monitoring profitability is there in the business or not. Business model should be very clear and crystal clearly. He should understand what kind of model he is expanding with the scale. Audited restated financials should be ready. Internal control checks and balances and people should be there. Governance practice and foundation should be very strong. That entrepreneur has to see in advance before he start his journey. He should also be aware about the lock-in requirement of the SEBI regulation. Total cost of IPO is not very easy and cheap, and it's a time-consuming process of 6 months to 9 months, and a lot of cost is involved. Quarterly earning pressure also, he should see that he may have a quarterly earning pressure will come, so he should be ready with his team how quarter to quarter the earnings will be going. Pitch and the story on the narrative of the company, he should be very much aware of what is the narrative and how he should pitch for the company's business. Valuation is again very key important, what value you leave on the retailer on the table. Timing is also very critical. The right time, the right IPO should come, and the strong investor relationship should be the key. If we see for the IPO, no, there are a number of rules, regulations are applicable to any company. The first and foremost for a company, the Companies Act is the master or the mother regulation or the act which will govern the company. Then Security Contract Regulation Act 1956, then the SEBI Act of 1992, read with ICDR, LODR, PIT regulation, and share-based employee benefit and sweat equity. These are all the regulation will be applicable. Depository Act, because everything is now in the DMAT. Then if there is a foreign investment coming, then the FEMA and NDI and ODI regulation, overseas investment, and the local investment FDI. Sector specific act and rules regulation also, which sector the company is into, that will be that the telecommunication or insurance companies will have been guided by or abided by the IRDA Act. The labor and taxation law and the regulations S of Security Exchange Commission if USA, that also if applicable. And for all these acts and regulation, you should have a right team, right mindset, and right time also for aligning all this compliance and regulation with the strong foundation of governance. Coming to the type of IPO, there are primary IPO, which will the new shares will be given to the public, whereas in offer for sale, the existing shareholders shares will be given to the public and it will be downloaded. And there will be a mixed IPO where there are both combination of primarily new offer and the existing exit to the existing shareholder also. If we see in as 2025 onwards, what are the why this is so much of frenzy and IPOs are coming, because there is a lot of domestic investor participation has increased since 2019. We have seen a lot of demat accounts have been opened for the retail investor. They are finding that it will be a like a game, or it will be they will get the money multiplied quickly. That was the reason, and there was no other opportunity, and good IPO, and we have seen number of companies have unlocked their value. So that was the reason domestic participations have increased directly, and through the SIPs, also through the mutual fund. And also the SEBI and Companies Act, there are a lot of amendment and major reforms are coming. They are supporting completely a new approach to support the entrepreneur, to even the global investors can come here, and foreign companies are also reverse flipping and coming back to India. We have seen number of such companies. So regulatory systems and SEBI keep changing and amending, making it more easy and user friendly, or the entrepreneur friendly regulations. And there is a lot of confidence of the promoter that there is a lot of potential in India. They can invest in India, and capital investment is also increasing. So these are the reason why the IPOs are coming since 2024. We have seen number of IPOs in the pipeline. If we come to the SEBI relaxation in last year, they have recalibrated the minimum public share offer norms. Minimum 25% also is reduced for the larger size. Then they also expanded the anchor investor allocation also to 40%, and bringing the pension and insurance fund also into the anchor investor. Promoter and founders earlier ESOP, or the grant which has been given 1 year prior to the DRHP filing, is also allowed now. If we see this year, 2026, there are some relaxations SEBI has given considering the uncertainty war situation. SEBI has allowed companies with their observation letter, which was expiring. They've extended a timeline for April 2026 to September 2026. So anything has expired during this period, that can be extended up to September 2026, and they are not required to refile the entire offer document. Similarly, they allow to adjust the size, not immediately or automatically, but it allows that adjust the IPO fresh issue size up and down up to 50%. Of course, subject to the procedural requirement, filing with the SEBI, and SEBI on a case-to-case basis will decide whether they will allow adjustment or not. So it is not given and granted automatically, but basis the application to be made to the SEBI, and depending on the SEBI's discretion. Similarly, there is a relaxation of the one-time penal provision for the minimum public offer. It can be also extended up to September 2026. Coming to the intermediaries who are involved in this complete IPO journey, the issuer has to first, there are a lot of intermediaries like merchant banker, legal counsel from the seller side also, and from the company side, systematic syndicate members, industry research, underwriters, credit rating agency, registrar and share transfer agents, printers, aid agency, depositories, and stock exchange. So you have to deal as a company secretary. If you are a company, or if you are a PCS, you have to deal with all these intermediaries and the company and the board of directors of the company. And then there are investors also, institutional investor, QIB, retail. And whenever there is a offer for sale, and there are foreign investors who are getting exit through the OFS, the company secretary has to deal with those OFS shareholders also. And of course, there will be a law firm separately for handling that case. Now, cost of IPO, typically it range between 3 to 5% of the total size of the issue, and the smaller the issue, the cost will be higher. That's basic. Like larger the issue, the cost will be lesser. And this all fees are covered: merchant banker, legal advisor, registrar, consultant fees, advertising, printing, compliance costs, etc., filing, and SEBI filing, or any government regulatory filing. If we see the stages of the complete IPO, from starting from the business plan, pre-IPO setting is the first and foremost important, according to my understanding, because you have to first set the house in order. So do the legal due diligence first before you even think about the company will have a potential after a year. You should start cleaning your books from the day one, from the inception, because your capital built up will be seen from the date of incorporation. So I think this pre-IPO setting up your complete house in order is the most critical stage, which company should not ignore, and company should not appoint the outside agencies before they clean this. and merchant bankers and other intermediary will be second stage. And then definitely once the kickstart meeting happens, and then quickly within 3 to 6 months after the financials are ready, they see and approach the, be ready for the filing the book or the DRHP. Then there's a marketing strategy, various approach to be decided. Due diligence, offer document drafting also takes time. Aid agency and investor relation IRPR form will come in. Road shows will happen. Pricing will be decided. Opening of the issue and closing of the issue. If you see the entire stage is 12 or 13 pointers, but if you see the entire activity, it is huge. Like it takes 6 to 9 months to complete this all stages. Coming to the typically for the due diligence for any legal firm or the company secretary's firm, these are the checklists for any legal due diligence. All the corporate matters about the company since incorporation should be considered and should be completely detailed and outlined in the book in the DRHP. So you have to put all the data in the VDR. About the capital structure, as I said, from the day zero, from the incorporation subscription till date, whatever transaction happened in the capital plus minus transfer allotment, all should be completely checked and ensure that it is proper. Object of the issue, risk factor, management discussion about the company, management, promoters, subsidiaries, government regulatory, financial indebtedness, movable and immovable properties with all the licenses and all their title deeds, IPRs and litigation. Litigation is a very important because up to the last date of filing, you have to keep updating your MIS of litigation with the company. With company has files against somebody or company has been sued by somebody. Even for the directors, independent directors, this litigation piece you have to completely monitor, keep checking, and update your MIS, insurance, HR, and miscellaneous. These are all the checklists. If we see the entire process from the day one, from the decision to go for the IPO, then you appoint your advisor consultant to clean the house, making the IPO ready. Then you appoint the merchant banker. They start the due diligence pre-IPO preparation, VDR setting, obtaining the credit rating. Industry expert will come. They will give the marketing strategy will be decided. Appointment of other intermediaries like printer, registrars. Then the filing of the first offer draft offer document with the SEBI, and there will be also a confidential offer also can be filed with the SEBI before it goes into public. Then approval or document exchange with the SEBI as per their requirement, and the query comes. And then finally issue price allocation, inviting subscription for the anchor and QIVs and listing, and then the fund transfer to the issuer. This entire process for the main board takes minimum 10 to 12 months. Of course, we'll hear from Abhinav some more his practical experience. And then there is SME IPOs. Reasonably within 6 months it can be done because you don't have to go to the SEBI. It will be only through the stock exchange to be filed. So I think that's it. I'll stop sharing, and if there is any query from anybody, we will take at the end of the session once we hear out from the Abhinav. And Abhinav is coming, as you have seen, Dolly has explained that he has handled number of IPOs and the big size of IPOs. So he will have a lot of experience to share rather than running the PPT like me. He will share his practical experience, and I would request Abhinav if you can just give us how the IPO transaction, according to your understanding or your practice on last 15 years, what do you find how it is different than the other transaction or merger acquisition or any other transaction? So can you just explain to the our audience?
Yeah. And thanks, Amita, and thanks for inviting us for this conference. Look, when the company is still private and it wants to raise capital, it's typical for them to go through the private equity route, where their target audience is a very sophisticated investor sitting on the other side who have large data crunching. Typically, in these transactions, there is a due diligence which is carried out, and it's an extensive due diligence. There's also financial diligence, legal, and there is a thorough exercise that a private equity investor does. But still, the target audience is the investor and a sophisticated investor. And there is a mutual contractual negotiation. A lot of compliance issues can be addressed through indemnities, reps and warranties, etc. But the moment the company decides to get into an IPO process, the gear really shifts into being in a public domain, because for both SEBI and for the company itself, the target audience is the retail investor. Now, you may do a 6-2 issue where retail gets a lesser percentage versus a 6-1. But from a regulatory standpoint, I think for both the company and especially the regulator, the focus remains to be a retail investor. And because the focus is a retail investor, we need to understand the history of capital markets in this country. That in 1980s, there were a lot of instances where capital issuances were raised, where disclosure norms were not very well formed, where people used to raise capital by putting, and I'm saying this because it may be familiar to you, but some of our audience may still be Gen Z and Gen Alpha. At that point of time, people used to have Hema Malini and Amitabh Bachchan's photo on the prospectus and sell it on that basis, right?
True.
Now, we've obviously come very far from that time. Our disclosure standards are now, at par with international norms, even to US, right? In fact, some people now say in India that we have an over-disclosure regime, and that still needs to be debated. But essentially, what happens in a private equity is that even if you find an issue and something doesn't get addressed, there are various ways that you can factor it in the valuation. You can give a discount, you can give an indemnity. But when a company comes to a public platform, it realizes the level of liability that you owe to the public is much higher, both during the listing process and post listing. Directors are personally liable. There are proceedings that can happen against the investors personally. They need to sign on on the dotted line saying that everything on a document is true, fair, and accurate. And those things are something which SEBI also takes very seriously in terms of liability. And the audience must, and I would urge them to read on certain orders like DLF order, etc., where SEBI has taken strict action for misstatement and offer documents which have been there. So we have a very rich jurisprudence of misstatement in the offer document. And the risks and liabilities are totally different when a company starts going into a public domain. Even on post-listing regulations and requirements, when a company gets private equity, yeah, you have certain information rights in a private equity shareholders agreement, which may say that you share your quarterly results, etc. But when you become listed, it becomes a mandatory requirement to make quarterly financials public. There is Reg 30 of LODR where any material disclosure needs to be disclosed. So honestly, for a company, it's a change in mindset. And I think companies have started taking that, and we are seeing an evolution, but a marked change, to answer your question, between a private equity and a pre-listed company versus a post-listed company.
I think private equity is always governed to the civil liabilities and not like a criminal liability, like we see in the if the DRHP or any offer document, any misstatement, it is considered as a criminal offense and criminal liability to the founders or anybody. Even for the merchant banker, it will be a huge responsibility to certify something and give a clean sheet. So definitely a lot of people are involved. And fortunately, SEBI apart, I mean, earlier nowadays, when I started my practice in 95, those are the CCI days where the Capital Control of India were doing. Now it's a SEBI since 1992. SEBI is also seen, and we have, I mean, past many, journeys happened. Like eventually the evolution has happened in the letter of offer. More disclosures are there, but again, SEBI is again consolidating and bringing it now as an average prospectus, so that the material information is being seen by somebody. So investors are also now a little bit smarter. Now, coming to the any company, as you rightly said, whenever the entrepreneurs are thinking about IPO, they are aware about their responsibility, liability, transparency, accountability, everything. But according to you, how company can prepare the groundwork before they start the IPO process? What is the first thing which they should start as a rule? What do you suggest?
Yeah, so Amita, I think we've been together advising companies on a lot of common companies on getting their house in order. And what is surprising is that wherever you go, and even now when we go and talk to companies, it's a similar problems. A lot of companies, when we go and speak to them, they say they are in the process of hiring a company secretary, right? During the IPO process, that's the first time they are actually hiring someone who's a full-time employee company secretary. And that company secretary, during the 3-4 months of getting their document filed, DRHP, has to get familiarized with the VDR, understand the history of the company. So they are also learning through the DRHP process. I think this is a cardinal sin. This process needs to start much earlier right? And which is why we tell companies that before DRHP filing, there should be a pre-DRHP preparatory phase where at least the basics like, appointing your company secretary, etc., should be, taken in order. There are various other things which companies should do, right, as a good practice, which is to understand that in an IPO, there are certain basic eligibility checks, right? So the SEBI ICDR regulation prescribes certain basic eligibility checks. And if you don't comply with these basic eligibility norms, you cannot get listed. So instead of spending money, and these eligibility checks are not simple, right? Uh, in certain cases, even around use of proceeds and why you want to raise capital, there should be a little bit of deliberation by the company to know the exact requirements why you are doing it. And if you don't, because there are norms and rules about how your money can be deployed, how much fresh can be raised, right? How much OFS can be raised, whether you're doing a 6-1 issue or a 6-2 issue, companies should be very clear about it. And in our practical experiences, we've seen that, when we go into an IPO, companies are still thinking about what to do about the fresh money or what objects to raise. And I think these are the kind of issues. And by that time, you've already hired a banker, you've hired a lawyer, you've already spent money, and you're going to spend that money anyways. Just be better informed about these decisions before you get into the process and start spending that money. Um, there is always also some sort of pre-IPO restructuring that a company is required to do because the share price is too high. So you would want to either do a bonus or a split or both. But knowing the taxation implications or short-term capital gains tax applicability on bonus issue, whether those shares will actually be beneficial to sell in the OFS, right? Do you have a minimum 1 year holding period which the law requires for you to sell, even for private equity funds and founders, is a very good education to have before they are doing the kickoff, which is why we insist to all of them to undertake this process much earlier and be well informed when they're going for the process. Uh, in other companies, we have seen that, companies have taken venture debt and they haven't looked at that there is a convertibility clause in a venture debt document. The company is an FOCC, they want to get shares at a pre-agreed price, but FEMA doesn't allow it. And we've seen transactions honestly get stuck for about 6 to 7 months or a year just on issues like these. Sometimes there's a large non-compliance, right? There is a compounding required, but there is no way in which there is no clear law on how the compounding can happen, right? So these are the kind of issues which we see on a common basis on a lot of issuances. And I think the underlying way or the remedy is actually to go in with a kickoff, knowing all of them and having remedied this, which is why I think it's pertinent that the topic that there has to be a pre-IPO preparedness, that you should go in a kickoff knowing that all of these issues are there and you should have solved at least a large portion of it.
And I think fortunately, certain companies where there are private equities already sitting, something is in order at least. But certain companies where they're only promoter driven, they assume that everything is in order, and suddenly for them also it is surprise. And before that, already they have started the kickoff meeting, and then everybody's bandwidth is chopped, and the company cannot go ahead without getting certain clarity on the way forward of compounding, adjudication, and somebody should have the knowledge and guidance to guide them in advance. So pre-IPO clearance, I think that's the right piece of advice which you are saying. Now, in your experience, again, can you guide us at what kind of legal due diligence areas which tend to create certain surprises later in the process? Though you already informed about the FEMA, that certain convertibility clauses are not there, or the bonus, there is a capital gain, then rather than going into the OFS could be a good thing. But certain, some from your experience, what are those surprises which has come to you later after starting some book and then has been delayed? Some one or two experience if you can share for us.
Yeah, no, absolutely. I think the big one that comes up all the time is on capital structure because, SEBI is so focused on having a clean capital structure, and which is why now on all the issuances, we get a PCS report on the capital structure as well. There are so many issues like in the past few transactions that we've been doing. I think not this year, but this issue came up, I think, about 4 or 5 years back. A lot of companies used to have this more than 200 investor issuances. And, we had lobbied to SEBI at that point of time that, look, some of the companies have done it inadvertently and allow them to create or, remedy these issues. Otherwise, there are so many companies who won't be able to go for an IPO. So, SEBI came up with a circular in the middle where you could give an exit to all of these investors, and there was a whole exit process defined. Now, this started somewhere in 2014, but I think a couple of years back, SEBI has stopped this process. So now, unfortunately, if you were a company who made an allocation or an allotment to more than 200, you won't be able to take that. Just taking an issue would be, or a public issue would be very difficult because you've done a public issue unknowingly without knowing it, right, under Companies Act. And we deal with issues where even company secretaries in the company or the issuers or the CFOs don't understand how this works. Like sometimes they would make an allotment to a fund and the fund would go and distribute within a year to more than 200, 300 people, and they don't understand that this is the violation of Companies Act. So, we've actually had those instances in recent transaction where we've had to tell company that, this won't be kosher, and that sort of stop the process right there. So, I mean, these are issues, again, you said, what are the deal breakers? I mean, these can be deal breaking issues. Similarly, on promoter group classification, sometimes you find out the promoter has involved in some RPT transaction, which can be questioned by the regulator, and there's no way to fix it. Or sometimes the promoter's family is involved in an ED proceeding or something like that, which can raise red flags. Or eligibility issues as well, whether your directors are fit and proper to be on the board or not. So those are the kind of aspects which we have seen, and similar aspects also come if there is a big litigation, like something which is either ED or CBI. SEBI looks at it with a very, very, very large lens. A lot of other companies, Amita, that we see are like regulated sector with strong sectoral regulators. So insurance companies like regulated by IRDA, or non-ban, NBFCs, or housing finance companies which have periodic inspections, etc. The issue always comes up is that if there's an issue which is highlighted in their inspection reports by the sectoral regulators, how do you make it public? Because these are confidential reports. And there's always a tussle between the sectoral regulator and SEBI saying that unless we don't allow, you can't disclose these issues. So these are very common issues that we have to tackle with entities which are sectorally sort of regulated by sectoral authorities. Similar issues for promoters and founders on MSOPs and how MSOP structures can be exercised, whether upside is allowed post-listing or not. I mean, these are common issues, but I mean, I'm trying to keep it generic because I know the audience may not be very well known about the fact, but just giving a flavor on what can be the big problems when we do IPOs.
Yeah, true. I think that's, or even I concur on that, that major issues are with the equity built up, or if the private placement has done not correctly done, or maybe financial informations are not correctly disclosed in the financial statement, or sometime auditors are small time or maybe started and then he has given his some wrong report. Certain jurisdiction in India are still on not allowing to refile the balance sheet. So certain ROC, unfortunately, it is a central law, but still Bombay ROC does not allow cancellation of your SRN number or Chalan number and refile. If there is a mistake of just consolidated financial statements were there for a year, we have come across such a thing, but then company by error, somebody has clicked that no consolidation required, automatically the drop down goes and the company is unable to file the consolidated. Now how to resolve? So the only way, sometime earlier days in the initial 2-3 years before, we used to go to the NCLT reopening, allowing them, but some jurisdiction in ROC offices, they allow Bangalore ROC with various Delhi ROC, they have allowed. So that actually resolve the matter very quickly. And majorly what in our legal due diligence, whatever we have come across, major non-compliance are section 42, which is a private placement, or CSR not done properly, or maybe sometimes financials are not disclosed properly as per the Schedule 3 requirement. These are very, very common errors. And of course, as you rightly said, promoter group entity, we have to see if there are RPT and there are violations. These are the major non-compliance. Registers are not updated. Companies are feeling that it is an ordinary course of business. I don't have to fill the details. And then it comes suddenly for certain companies. We have done cleaning up for 20-25 years also, though only on the capital built up, because capital built up is not required just for 3 years since incorporation of the company. That's the biggest piece of cleaning up, and that delays everything. And certain also we have seen that in FEMA there is a downstream investment. Sometimes companies are forgetting to invest and intimate to the RBI under a DI form, and that is also a lot of time. It takes 6 months to complete the transaction and getting the penalties or the filing to be done. And I believe now the SEBI is also asking that before filing DRHP, the quantification of penalty should be there. What is your view on that? Any you can clarify on that?
Quantification of which penalty? Sorry, Amita.
Any penalty of FEMA or under the registrar of company, that has to be quantified before filing the DRHP, or at the RHP stage also is okay? If you can just
Yeah,
throw
I
some
mean,
light.
I think what SEBI is basically saying, and SEBI's view has been, and what we've been telling SEBI is that, look, in all instances, it's not possible for us to quantify penalty, especially with RBI, because you may go with an estimate of a penalty at the DRHP, but nobody wants to take the liability for it because we don't know the amount of interest that, let's say, an RBI would apply to this. To the extent you've made an application, this is fine and SEBI accepts it. But SEBI will not give you the final observation till the compounding is done. So, your possibility of doing an IPO is absolutely dependent on this fact. So that has been the SEBI's view for a very long time. And it's the same with compounding, right? You go to the ROC and you can make an application and you can file a compounding, but you can do it post DRHP filing, provided you provide risk factors, etc., and disclosures in the document. But SEBI's been fine if that happens, provided it doesn't give final opinions till or final observations till you get that compounded before the final operation.
Quantification, yeah. So till that time your RHP is, so everything gets delayed because of that. Yeah.
Yeah.
And what other kind of an application normally after the DRHP company people may file, like as you rightly we have discussed about the your raising of issue size can be a plus and minus. What other kind of an application normally company can file, like if the relatives are not related to them but they have to give the disclosure, can an undertaking is okay, or they have to file some certain application to give the exemption for certain disclosure?
So any exemption, most of the exemptions which were there from for promoter group, it's very common for a promoter group to have dissociation with relatives or immediate relatives, just a reality of life. There are cases that come where husband wife are separated and they're technically not divorced and still husband and wife. What happens in such cases? That's a very common question. Any exemption, by the way, that needs to be filed has to be filed at the DRHP stage. You can't file it post DRHP filing. And that is also, the sooner you do it, the better it is, because exemption applications at SEBI take a long period of time. It's an iterative process which goes all the way to the SEBI governing board. And even in this new 50% exemption which has happened, right, where SEBI is allowing entities instead of 20% to 50% reduction in fresh issue size, it's actually an approval process. It's not automatic, right? So while between DRHP to RHP, you can do a reduction of 20% automatically, you don't need to file an application. This special dispensation because of the Iran war, which SEBI has done, that is only if you're able to show or demonstrate that any of your major objects are not getting deleted, that there is a solid rationale for you to reduce it to 50%. So it is also an approval process. I think there you'll have to make an application to SEBI and wait for them to approve it, but it does have an impact on timelines.
Yeah, thanks for clarifying that. And it's very important. Your practical experience really helps a lot. One last question for you, that if you could just give one piece of advice to any founder who is coming with the IPO preparedness 2 years in advance, what is that would be? What could be that advice from you?
Yeah, so look, Amita, the advice that we would give to, and we often give to founders a couple of years before when we're doing some M&A or private equity round with them, is that start looking at late stage capital as a precursor to an IPO, and start looking at that as a way to segue into an IPO and be IPO ready from that time on. Whether it is negotiation on MSOPs, because promoters If you're a promoter or holding above 10%, Companies Act won't allow you from an ESOP standpoint. So if you're looking at EMSOPs, how will you structure these EMSOPs? When do you want to exercise it? What's the exercise price? And secondly, just getting the house in order in terms of your compliances, getting a company secretary and a CFO in place, etc. Those things, and a couple of issues which are, you said that private equity run entities tend to be slightly more organized, and I agree with you. But we also find surprising that sometimes when we diligence entities which have private equity investors, some of the issues on secretarial compliances or ROC compliances or RBI compliances have not been taken care of, purely sometimes because the guy sitting there has taken a view which may not be a correct view, or sometimes this was not considered at the private equity stage to be a very big issue. This may be about a rights issue that the founder did by adjusting capital or not adjusting capital, those kind of issues. But because it was the founder's shareholding, the investors didn't take it too seriously, and the founder said, "It's my share, so how do you care?" But that mindset has to change at the IPO stage, because founder shares are the most important for lockup, right? And
Correct.
which is the other advice that I would like to, which I give to all the founders that we are advising, which is that think about promoter contribution, think about the fact that you could be named as a promoter, and at that stage, you may not be, your holding may not allow you to become a professionally managed company, and think about post-listing scenarios as well. And the good thing about India is that investors are not looking as IPO as the only milestone or end milestone
Exit
after which
option.
they exit. They realize that they are not going to exit. It's a way to access public capital and getting a larger pool of investors. But an IPO is just an event that happens, and then
Correct.
there is a life beyond that. And that life is difficult because every quarter you have to go to the public and declare your results and do investor calls, and the scrutiny increases. And it
Correct.
really is a mind shift set, which is why professionals like you and I are relevant, because we are able to guide the company to help that mind shift happen. So yeah.
Yeah, I think that's a great advice. I think people are just considering that IPO is just going public, getting money, but it's coming with a lot of accountability,
Yeah.
responsibility, and that completely needs a cultural change in the company about more transparency, accountability, and a good team required for the complete pre-IPO, post-IPO, definitely more than the pre-IPO, because now you are in the public domain, more accountable.
Yeah.
I think thanks a lot for all the
Uh,
answers, and I think we have few question
we have
answer.
a few questions, yes, Amita, in the Q&A
Yeah,
session.
I
So
will just read
take it
out
up.
for,
Yes.
yeah. So I think, Abhinav, we have one question. What is the relationship between the valuation and the IPO raise and offer made? Maybe you would
Yeah.
like to answer that valuation and the offer.
Yeah, so look, valuation is a complicated issue in IPOs, and it's both a science and an art. All offerings, or majority of the offerings in India, are book built offers, which means that there is no valuation which is done by a valuer. There is a determination that happens between the board and the merchant banker, who, after a roadshow presentation that they do, and after speaking to investors, there are various questions that can come up in that process. Some of which are that, how is that valuation done? SEBI can ask those questions if the valuation is too high. The public scrutiny can be very high. And off late, when some of the offerings have happened, you would see media reports on why the valuation doesn't make sense, how peer companies are higher than that. And there are certain KPIs also which SEBI also compares. And while we are in a free market, sort of scenario where SEBI does not sit down and decide the valuation of the companies, it definitely raises questions, so that there is no market manipulation. And there is no cartelization between investors and the banks to increase the valuation of the company, which is what SEBI is concerned at. But ultimately, the way a valuation gets decided is that the board would sit with the investors, a board would sit with the bankers, look at what the feedback it has got on the roadshows and after talking to investors, and decide that. You would decide on a price band. The price band needs to have a minimum sort of gap in between, which the ICDR prescribes. Then in a book built offering, wherever at whatever price you get the maximum subscription. So let's say between 100 and 105, and if your offer, the highest price at which the offer was completed was at 104, 104 becomes the price. So that is how pricing is decided. There is no private valuation which is done like in a private equity transaction or an M&A.
So there are a fixed price and there is a book building price, but nowhere the valuation is a free flow, unlike the CCI, where the valuation was determined by the CCI Capital
That's
Commission
correct.
and earlier. Now the SEBI has given a free hand. It's a market driven on the demand supply side. So I think that replies the question. The second question is, could you give some insight on the role of independent director in the IPO process? Abhinav, if you would like to describe or something, because independent director role is very much defined under the LODR also and under the Companies Act. So during the IPO process also, maybe KPI, how do they, maybe you can throw some light on that, Abhinav?
Yeah. So I think in independent directors have now had much more larger role in an IPO than it was earlier. I mean, independent directors were always considered to be gatekeepers for a company and acting on behalf of the retail investors. But SEBI's expectation from independent directors has become even more, as Amita said, that now they are required to also approve in the audit committee and as by the independent directors, all the KPIs of the company have to be approved, right? So there is an additional role which is put on them, although that can be questioned because honestly, all investors have, all directors have fiduciary responsibility towards the company and shareholders, and independent directors are no different from that. But it is assumed that they are gatekeepers for the retail investors and therefore will have a little more safeguard mentality as opposed to the other executive directors, which may be shareholders also in the company. Some of the things which are there is that, composition of certain committees are driven largely by independent directors, like audit committees, two-third independent. Similarly, there is a independent director driven stakeholder committee where majority tends to be independent directors. These committees have specific responsibilities in terms of financial oversight over the company, in terms of what gets disclosed in the offer document. What we are now seeing in issuances, honestly, is that because these independent directors are also signing the offer document, they ask much more stronger questions than the executive director does, especially in founder-driven companies like Zomato, Paytm, etc. They would ask much more pointed questions and would want to take a discussion with partners at law firms before they sign this document. So that is the importance of independent director, and it's getting more and more important in IPOs as we go along.
Yeah, their actual responsibilities start as soon as they join the company, whether the IPO started or not. But they have their independent role, and during IPO, this, as Abhinav said, there are a lot of responsibility on them. The question is, what are the top 3 areas where the companies are most underprepared when they are enter into the DD process? I think we already discussed elaborately in the discussion that about the capital built up, about their financials, and those are anything more you want to add, Abhinav? Here,
No, I think that's that. I mean, if we can
that's
just
sufficient.
reiterate, I think it would just be capital structure, RPTs. Also, I don't think we've spent enough time on financials, but we see a lot of things on the financials also, especially when companies transitioning from Indian GAAP to Ind AS. But that is driven more by the auditors, and which is also critical process in the whole IPO. I mean, auditors are also our partners in the entire process, and the audited financials also are a very key aspect of the whole offer document. So I would say your underlying documents and the true, fair, and accurate picture of the audited financial statements for the last 3 years is also critical, as we've been seeing in some of the IPOs we've been commonly doing, Amita.
Yeah. One question from Siti goes, how to cater the PIT regulation when the listed company driven by investor? So I think PIT regulation, they have to comply. I don't know, what do you mean by listed companies driven by the investor?
So listed companies
regulation.
are listed. I mean, I think the question that that is being asked is that, look, if you have a private equity investors, they have certain rights, etc., which they seek, like information
Right.
rights. Then how do you comply with it? The answer to that is all of that falls away at listing, right? And your insider trade, when your insider trading regulations kick in, technically the investor, even if the private equity, even if they are at the shareholder level, do not get any rights which are different than other mutual funds or retail investors. They can have nominee directors, right, on board, but technically a nominee director is not allowed to share insider information which it gets during board meetings to the investors. So those restrictions are pretty strong. There are certain SAT decisions also on PIT regulations and sharing of information. There is an exception under the PIT regulation called the legitimate purpose exception, but that doesn't apply to nominee directors sharing information with their nominating shareholder. So, whether it's a private investor, whether investor has 30%, 40%, 50% post listing is not going to decide or dilute the applicability of PIT regulations. Those apply commonly to all shareholders.
Yeah, so automatically post listing the restrictive line or the article of association drop off, having the extra right or something.
Yeah.
The other question is how the floor price or cap price is deciding. I think the basis of allotment, that's what I mean. How the floor price and the cap price. It's a demand supply, and that's how the range is decided.
Yeah,
Abhinav, can you
so
just
practically how you would do is that you can't do it can't be a free float. There has to be a comparator, and there are various comparators when you decide. So one is how are the other peers priced in your comparable sector. So for instance, if you're a company in tech, how are the other tech companies in similar space priced? Okay, you can't be too way off them. So listed peers would be the other, and then you would compare your financials against them to decide that. Then there is investor feedback. It also depends a large way as to how you were valued in the last round on which, or the last capital raise that you did. So there cannot be too much of a gap. So let's say if you became a unicorn during your last round, as is happening in a lot of other issuances, it cannot be that you become a $2 billion entity when you go for an IPO, unless there are various very solid reasons why you feel that listing will change that. So a lot of these factors go into it. You do a comparison of against other companies and how they are trading, and again, this is a bit of a science and a bit of an art, and you arrive at a price, and it's all market driven, right? So BRLMs help you decide that based on all the determination, and board takes the final call on this. But there's no, I mean, I can't give you a scientific formula on how this is done.
there is no such formula. It's a demand supply and driven with the market and other factors as benchmark to the peers and etc.
Correct.
Other question from Shraddha Thapar is how successful is the confidential pre-filing route, and does it actually offer any practical advantage? Of course, yes, but I think you can elaborate something more. But I think many companies are going pre-filing route to have the confidentiality maintained unless they finally decide to come with the DRHP. Before that, why they should disclose to the peer or the competitor? That's the purpose of pre-filing, a confidential filing, and it really helps. And there is a practical advantage, according to me. Abhinav, you can give your experience.
No, I think you've said it. I think that's what it is. I think the whole idea was that this process was applicable at the time in which, even in US, there is a confidential filing because sometimes, and lots of factors, right? You don't want your competitors to know what your KPI is. You don't want to tell the public what your plan is, why you're trying to raise capital. There may sometimes be risk factors which are there in a document you don't want to disclose to everyone till you're absolutely certain you want to do that IPO, and you have demand. Some companies are slightly more cautious because they see that there are, let's say, consumer companies, the moment they file a DRHP, start getting a lot of complaints, and sometimes these complaints are by mischievous actors who are looking to gain something from the company, or competitors would urge the company to do it. So because of all of these reasons, companies decide to do confidential route, and if they don't find anything, then there is no disclosure made or any. So they think that the reputational risk by that to that extent, and the information they've given to the public is slightly lesser, and therefore that is the biggest advantage they get. In any case, once they decide to go public, there is a UDRHP 1 and UDRHP 2 that they need to file, which gets publicly disclosed anyways. But at that point of time, the company is much more certain about the fact that it's going for listing. Yeah.
Correct. Why to give in the public domain any detail when the company is still not deciding or not very certain? So I think there are a lot of practical advantage to it. One more question, that can you give idea on applicability of credit rating agency and required disclosure from these rating agencies? Abhinav, over to you.
Yeah, I don't think per se there is anything on credit rating agency. There's separate instruments which are there. Like for instance, if you're filing an InvIT REIT IPO, you need a credit rating report. But this is equity, not debt, and therefore it's not required. But if credit rating agencies provide any adverse remark or give anything or highlight any risk during their rating, I think that goes as the risk factor in an offer.
I think that's it. Those are all the questions. So we are closing in time. And thank you so much, Abhinav, for sharing your experience and giving all answers to the queries raised. Thank you, Dolly, for your support. And we look forward for the second series of IPO where we'll share more practical experience by the promoter now. Next time we are bringing the promoter who has completed such transaction and who has experienced how the life pre and post IPO. So I think stay tuned. Thank you.
Thanks for the invite, Amita. It was lovely. Thank you.
My pleasure. Thank you so
Thanks.
much. Thank you.